Welcome back to Switzer. As per usual, and with great expense to the station, we have the much-loved Roger Montgomery talking about a very important topic, cash flow analysis, and how it influences business performance and ultimately the selection of by wise investors. Mate, thanks for joining us on the program.
Okay.
What's your feeling about the market now? I know you generally worry about what's going on in the market, but hey, what's your view on it?
I read a lot of material. And I get copious quantities of research and opinions across my desk every day. Yeah. And one of the stories that I've been following now for some time is this idea of not necessarily another recession or a double dip in the United States, and there's a lot of fear-mongering about that. I don't necessarily think
some
we'll
of
have
your friends too, but we won't talk about them, Jimmy Chanos and people like that. But go on.
Okay. Well, I thought you mean my real friends. You're not talking about the guys who say they are in the street, but they're not.
Yeah, that's right.
So what I think is that I like this idea of more frequent dips and more frequent recessions, but not necessarily a recession right now. So there's this idea, very simple idea. Business cycle, you get troughs and you get peaks in the business cycle. Yeah. And if you're like China and your trend rate of growth is 8 or 9%, then the dips of the business cycle never get to recessionary level because that would be a phenomenal drop to get down to that point. But if you're in the United States and many other countries where you've seen trend growth declining for 40 or 50 years, and it's now at sort of 2% or 3%, then that business cycle the dip doesn't have to go very far to be in a recession again. And what I think we're entering, and we've been heading this way for a while, is not necessarily a recession right now, but the prospect or fear of more frequent recessions going forward. And what that means, of course, is that the stock market never gets out of its sort of sideways range for a long time. Now, I'm not an expert at market timing. I don't propose that I know when the market's going to bounce. But I do think right now we're entering a period of fear about another recession in the United States, and that's pretty obvious. And so we're seeing lower prices. Combine that with the fact that over recent weeks I haven't seen a lot of value, and I've been saying to your viewers on your program that I haven't seen a lot of value on my blog. I've been saying can't find many things to buy. Haven't been talking about many stocks. Previously I was talking about a lot of companies, and I think this company's really good. Haven't been doing that much recently.
So this topic about cash flow analysis was just the fill in the time because you've got no stocks to talk to me about.
Well, it's coming up. We're coming up to earnings to reporting season, and so I want people to understand how they can really quickly cut through the detritus, cut through a lot of the spin, and work out whether a company's actually making some money. And this is the way to do it. So
before we do it, one little thing. I picked up an interesting fact today. Some of the numbers could be wrong, but the US market usually will have a 10% correction about every 160 days.
Really?
We've gone about 283 days without a 10% correction. So that's why I think we're overdue for a bit of real bumpiness.
Peter, sorry to be...
And that's over an 80-year period, by the way.
Sorry to be a bit cynical. Is that a little bit like going to the casino and saying, well, there's been lots of reds there, so if there's been 8 reds in a row, it's going to be a black coming up soon?
You don't be cynical. It is the law of averages, and the law of averages can be beaten. You know that. But sometimes you put the law of averages together and you average out...
You can build a story. If you can build a fundamental basis for what you're saying, I'm not in any disagreement with that.
Okay, fine.
And I think fundamentally, we are in a period where there's some fear about the prospect of another recession. Don't think we'll get one.
No, I think so either.
But definitely the business cycle is still working. It's still there.
I think there'll be low growth in the US and low stock market returns as a consequence. But now, go to cash flow.
So what I want to do is I want to explain through the balance sheet how it's very easy to work out what a company is actually making. So people need to get their pens.
Okay.
They need to draw 2 columns.
Well, they can tape it and watch it over and again.
They can tape it, Press record on your Foxtel, on your IQ, what's it called?
Foxtel IQ.
Foxtel IQ. Press record, and here we go. So you want to draw 2 columns, one for 2010, which is last year's results, and a column for 2011. We're going to put 3 items in each column. So we want cash at bank, so we want the cash balance at the bank. We want short-term borrowings and long-term borrowings. They're the 3 items that we're after, and we're just going to put those in on the left-hand side, and we want the numbers for 2010, numbers for 2012.
We're looking at X company. And
so company X. So for 2010, this company that we're talking about had cash of $10 or $10 million or $10,000, doesn't matter what it is, 10. 2011, the report comes out, and it shows 20.
So it's gone from 10 to 20.
So it's gone from 10 to 20.
Cash at bank looks great.
Now, everything else being equal, if we were running that business and we started the year with $10 million and we ended the year with $20 million, we've made $10 million, right? So that's our cash flow.
Provided I haven't borrowed the money.
Well, hang on a second. I said make sure nothing's actually changed.
Okay, right.
As long as nothing else has changed, 10 to 20, we've made $10 million bucks.
Ceteris paribus.
Put a negative sign in front of both of those numbers. So that's what I want people to do. So negative 10, negative 20. Okay, next item down, short-term borrowings. We're going to assume last year, 2010, $10 million of debt. This year, $30 million of short-term borrowings. Okay. We're not putting negatives next to those. Leave those as positives. Long-term borrowings, 10 last year, and when this year's report comes out, 20. Okay. Right. Now what we're going to do is we're going to add up the 2010 column. So minus 10 was the first number, that was the cash. Plus 10 equals 10. So we end that year, 2010 is the number 10. For this coming year, or the 2011 report comes out, we started with minus 20, plus 30,
the cash column.
Plus 30, plus 20, which gives us plus 30. What we're going to do is we're going to subtract the 30, this year's number, from last year's number. So 10 minus 30 equals minus 20. So what was the cash profit of the company this year? Minus $20 million. So in the first instance, the cash went up from 10 million to 20 million. This company borrowed money. That's where the cash came from. And it borrowed more than the cash went up. So that money's gone somewhere. It's lost $20 million. Now, there's a couple of other items. Can I just finish off, Pete?
Yeah, of course.
So after we've got that minus 20, we want to know how much equity's been injected into the company. So if additional money's been put in the company, you've got to subtract that from the minus 20 as well. So let's suppose an additional $10 million was put in the company over the course of the year. Bonus issue, rights issue, share options exercise, so on and so forth. Capital raisings. So we'll assume that $20 million of additional money was put in. Okay, so we're going to subtract 20 from the minus 20, we get minus 40.
It's looking ugly by the moment.
One more item. One more item. We're going to assume $20 million of dividends was paid out as well. We want to take out that effect.
Keep people happy.
Right? That's a positive.
Keep them happy while it's going up.
So we add the $20 million that was paid to the number. So we've gone from wherever we were a minute ago, add on $20 million, and that's the true cash. That takes in all the other elements in the balance sheet. Everything that company has done has resulted in that cash flow number. So you can do that. It takes once you get used to it, it takes 20 seconds to do, and you can see. Forget about the
heads will be spinning out there in viewer land, you know. But thank God they recorded it.
Press rewind now and play it back. Write it down.
Was
I'll
this
put it on the blog.
Was this actually modelled on a real company?
This is modelled on my business when I first started it. What people need to do now is if they go to the blog tomorrow, I'll put a piece up on the blog that actually gives all the numbers. And they can look at it.
Can you name us some companies where you think their cash flow position is fantastic?
A company, for example, like the Reject Shop, it's had a tough year, obviously, because of the floods.
Good result, wasn't it?
Floods in Queensland, obviously. But if you go back over time, you find that the cash performance of the company is actually as good as the reported profits. So this is what we compare to reported profits.
Next time you come, give us 10 companies where you think their cash position is absolutely brilliant.
And what about 10 that are brilliant and 10 that are atrocious?
That's right. But, and also the ones that are brilliant, you can say, if there are other problems there, you can actually mention that. But give us 10 great companies. We
never get through 5, mate. Do you want to do 5 of each? 5 of each. Do 5 of each. Okay, we'll do 5 of each.
So 5 companies with really good cash flow, because that is a nice foundation for assessing whether you want to be a part of that sort of company.
No problem. Be delighted to do it.
As always,
thank you.
Great having you here, mate.